Hello and welcome to this edition of Know Your 4C Fund Manager series. I have with me today Vinay Paharia, Chief Investment Officer at PGIM Asset Management Company. Welcome, Vinay. To
Thank
this
you.
show. Just to start off, you've been in the markets for over 2 decades. How has your investment strategy or style really evolved over this period of time?
Yeah, so I started out as a pure play value investor, buying cheap companies, thinking that cheap companies would do well because when you buy cheap, you have very good margin of safety, and markets would eventually re-rate it over a period of time. So that was my starting point. Over a period of time, I evolved into buying growth companies at reasonable prices, because what I discovered is that eventually the return of an investor equates very well to what a company's underlying intrinsic value grows to. So I think it's more suitable to live organisms like companies. Value investing is more suitable for vulture investing, for companies which are about to die and so on and so forth. So I think for Indians it suits well.
And in this particular style, what kind of sectors would be, let's say, core to your portfolios that you manage?
Yeah. So generally, the approach is to buy good quality companies. And when I talk about good quality, it means companies which have, on a structural basis, above average returns on equity over a long period of time. So that defines quality on a very quantitative basis. And these companies should also exhibit a higher than peer group growth expectation. Once again, not just for 1, 2, 3 years, but for a much longer period of time. So the growth runway for such companies also has to be higher than the peer group average. So when we have both these things coming together, we have what I call as good companies which have a good growth prospect. These type of companies exist in all types of sectors except one, which is commodities. So I think commodities is a sector where we generally do not find many companies which generate higher than average returns on equity. Of course, there have been exceptions, for example, in the cement sector, for example.
Right.
So I think, but generally we are able to spot opportunities across different sectors.
Now, when you look at the markets over the last couple of years, you've seen that earnings growth has been fairly healthy, and that has provided some kind of cushion to market valuations as well. Do you see earnings growth really sustaining? And from whatever you've seen of the current earnings season as well, which kind of sectors are likely to drive the performance going forward?
I think one thing which I've learned is that markets are not very near-term focused. In fact, the markets are nearly completely efficient on the short-term basis. So you, for example, you can't make money preempting what can happen over the next 6 months. But if you elongate your investment horizon, you can identify many more inefficiently priced securities. So I would actually look at from a longer range point of view what could be the likely outcome.
Sure.
And as a corollary, companies in India are likely to grow at a much higher rate than even GDP, because what we are talking about is the listed universe. And listed universe is largely consisting of organized companies, companies which are which are paying taxes, which are in the formal sector. And all of these companies are actually seeing a very big shift in their favor in terms of demand. And hence, most of the listed companies are actually growing on an aggregate faster than the nominal GDP growth. And hence, over the next 2 years or even 5 years, we expect many of these companies in the listed universe to grow at a pace slightly faster than the nominal GDP growth rates.
Right. And within your portfolio construction, how are you positioned in today's context?
So within our portfolios, once again, we look at largely a bottom-up approach. We take that approach, which is buying good quality companies which are growing at a fast pace. Now, an overlay which we also use is a fair value approach to valuation, which is a much more comprehensive approach to valuation, which takes into account growth of the underlying companies, the returns on equity, the riskiness of a business, and the interest rates. when you look at all of these factors, we come to what we call as a fair value of a company. When we look at that and we look at the prices at which companies are available, we can see the potential upside. And overall, we create a portfolio which consists of companies which have a reasonably good potential upside, with which are and the portfolio is reasonably well diversified, so that the risks are taken care of. So I think that's how we generally create portfolios.
Right.
So
And on the sector front, if you can just
Sure.
take us through some of those sectors.
So at this point of time, the way our portfolios are positioned is we are overweight financials. I think that's a consensus overweight. But we are also overweight healthcare sector, and we are overweight consumer discretionary sector. We are underweight sectors like industrials, which is contrarian at this point of time. We are underweight the IT sector, and we are underweight commodities. Largely, the reason why we underweight commodities is because we find limited number of companies which satisfy our investment criteria.
Sure. Banking, you said, is a
Is
consensus.
absolutely.
But do you see the earnings growth or the kind of credit offtake that has been happening? Do you see that sustaining going forward?
Absolutely. So I think there is a big shift which is happening in the banking sector, and within the sector there are a lot of shifts. In fact, for example, a lot of deposits and loans are moving from public sector to private sector, for example. Then there is a move towards higher retail loan growth. So you can look at, for example, credit cards as a spend. They are growing significantly. The retail borrowing for personal loans or home loans is growing fast. So I think there is a structural component within the financial services sector, which we think can do well for many more years to come. There could be some cyclicality, but if you ignore some of that, the structural component is significant, and I think that's where we are largely focused on.
And what do you like in the pharma sector?
Within the healthcare space, we are largely overweight on, once again, structural sides of the market, which is health hospitals or the CRAMS kind of opportunities, or some of the Indian pharma companies which are focusing on the Indian pharmaceutical markets, because what we see them is they are largely FMCG companies hiding behind pharmaceutical names.
Right,
So, yeah.
right. Now you mentioned you're underweight on the IT sector, and a lot of it is to do with the way the global markets are behaving right now. What will make you sort of turn positive?
Sure. So I think one of the reasons why we think IT companies could face some more challenges over the near to medium term is because their customers are suffering. And one of the popular phrases which I heard by one of the customers is that they generally tend to share the pain across the entire vendor basket. So that pain is not yet shared.
Right.
So I think there could be some impact on margins going forward, which means pricing pressure and some bit of volume pressure in the IT space. But once we see that, I think we'll then clearly probably be able to see potential growth after that. But till that time, we should be a little bit more cautious.
The other important sector from an Indian economy perspective is consumers. Which are the spaces within that you like?
Sure. So I think you rightly touched upon a space which is structural. Like when we discussed about the financial services, we touched upon the retail sector of the financial services, which is also consumer loans. Similarly, on the consumer side of the market, we like consumer discretionary companies. We like sub-segments like the quick service restaurants, and there are numerous bottom-up opportunities which are exposed to growing consumer demand. For example, the luxury space. We are seeing a significant growth in incomes of the top 1% of the population, and these people are ready to splurge that money on a lot of things like wealth management, like luxury cars, so on and so forth. I think those could be very interesting structural long-term opportunities, and we are trying to spot opportunities and remain invested in those spaces.
Right. Now coming to the other facet, which is market cap allocation, right? And you as a CIO are in charge of the entire universe. So are there pockets of opportunity that you see across any of these? And over the last few years, the mid and small cap category hasn't particularly done well vis-a-vis the large cap. Do you see a change in tide over the next few years?
Yeah. So the way we look at and judge the valuations for individual companies and aggregate sector capitalization is to look at what is the potential return over the next 5 years based on the current prices we pay. For example, if the large cap segment has a higher potential return, it means that that segment is cheaper. Having said that, as we see it today, we find that the potential return across the entire cap curve, which is large, mid, small, is almost similar. So I think we are pretty excited about and optimistic about all the three segments of the market going forward, and we don't think so that one is more cheap versus other.
India is, for all practical purposes, a structural growth story going forward, and it's a shining light given the way the world economy is moving today. What is your long-term outlook from an India perspective?
I think the long-term outlook is has been very positive, but that outlook has significantly strengthened of late in the last 2 years because of what we see all around us. For example, the Indian monetary policy has been significantly ahead of the curve compared to most of the developed world. When we look at the impact of this in the Indian rupee, that's the proof of the pudding. We see India's economic growth being significantly higher than, once again, rest of the world, largely due to Indian fundamentals. So when we look at the fundamentals of the economy, the owners and managers, which means the political system, the monetary system, all of these are working together, and I think that's a lethal combination for long-term structural growth. And clearly we as a generation are very, very fortunate to have such a significant growth lying ahead of us, and I think we should take advantage of that as well.
On that positive note, thank you so much, Vinay.
Thank you, it's my pleasure.
Thanks.